everybody, and welcome to this week's edition of The Real Deal with Rob and Leo, where we get you the most current and up-to-date information for Southern California real estate. I'm your host, Leo Gonzalez, president of Crown Group Real Estate. Today we have a special treat for you guys. We're going to show you exactly what it takes to become a homeowner in today's market. Now, even though our board does resemble my 5-year-old cousin's science project, it's still great information that you guys are not going to want to miss. Stay tuned.
Hello guys, my name is Robert Rivera, mortgage consultant with International City Mortgage. Thank you for stopping by in today's show. We're going to be talking to you about the 3 key ingredients to becoming a homeowner, which are income, credit, and down payment. So let's get right into it. Very first question I get when I'm sitting down with the client is, Robert, how much money do I need for my down payment? The truth is, it just depends on what kind of financing you're going to get. Most first-time home buyers tend to go with an FHA loan. Your requirement or your down payment requirement on an FHA loan is 3.5%. So let's pretend that I'm buying a $100,000 home and I'm getting a FHA loan. My down payment is going to be $3,500. Now, if you're a second time buyer, you probably have a little bit more money saved up. You want to go with a conventional loan. You're going to be looking at a down payment of 5 to 20%. So again, let's pretend I'm buying a house for $100,000 and I want to go conventional. My down payment is going to be between $5,000 to $20,000. Now, in the last market, we had a lot of people who bought a home, they lost a home, it had a short sale or foreclosure. Those people may have money. However, conventional will not allow you to get another loan unless you wait 2 to 3 years. So for those people, you could still go with an FHA loan with 3.5% down or more. Our last loan is a VA loan. So to all of our brave men and women that have served in the military, you get 100% financing. Yes, let me repeat that again. All our brave men and women in the military who qualify for a VA loan have a 0 down payment requirement. A VA will give you 100% financing with no mortgage insurance. Another question I get asked a lot is there any down payment assistance programs that are available? The answer is yes, there is. The down payment assistance program can be combined with an FHA loan to help you get into that house. Also guys, I want to let you guys know that FHA allows your down payment to come from either a gift that's given to you by a family member, a friend, or even an employer. So if you know somebody out there who's been with their employer for 20 plus years, you never know guys, it might be worth asking your employer if they'd be willing to help you with a gift to get you into that house. So now that we've talked about down payment requirements, let's move on to credit. What are lenders looking for when they're looking at your credit? Well, we're looking for a 2-year history because we want to make sure that you've made payments on time and that we can count on you to make that mortgage payment. We're also going to be looking at your total debt. Your total debt is made up of anything that's on your credit, like your car, your student loans, your credit cards, anything of that nature. Also, let's say you co-signed for a member or for a friend for an auto loan. That auto loan, although it's not your debt, you co-signed for it, the bank's going to count that debt against you. So again, guys, not only are they looking at your credit history, they're looking at your total debt. Now, another question that I get asked is, what's the FICO score that I need in order to qualify for a home loan? In today's market, the minimum requirement on your FICO score is a FICO score of 580. But if you want to get the best rate possible, you really want to bring your credit score up to a minimum of a 640. That's what I recommend to all of my buyers. A 640 credit score or better is going to guarantee that you get that better interest, which means saving you thousands of dollars in the long run. Now that we've talked about both down payment and credit, let's move on to your income. What are we looking when we're looking at your income? For starters, we're looking for a 2-year employment history. We want to make sure you've been on your job and you're going to be there to make that mortgage payment. I have a question that gets asked a lot. What happens if I'm going to move to another job? The bank is not going to penalize you for moving to another job. However, they do want to make sure that you're going to keep the same income or you're going to make more income. So if you're thinking about moving jobs or industries, feel free to do so. Just make sure that you're going to be making more money. If your income decreases, that's not going to look good. Another example is someone who was first a W-2 employee who's now trying to be self-employed. That's a big no-no. When it comes to self-employed individuals, bankers want to make sure that you have 2-year history because they want to make sure that that business income is going up, not like the U.S. economy going down. So again, guys, if you want to move jobs, feel free to do it. Just make sure that your income is going up. Last but not least, I want to save the best for last. Let's talk about your DTI requirement. What's DTI? Your DTI is just a fancy word for debt to income ratio, or in basic English, the difference between how much you make and how much you spend. As of January 10th of 2014, the qualified mortgage rule has a requirement debt to income of no more than 43%. What that means is that no more than 43% of your income can go towards your monthly debts and that new mortgage payment that you're trying to acquire. So let's say that I'm a first-time home buyer, I make $5,000 a month, and my monthly bills, including my car loan, my credit card, my student loan, and that other loan that I co-signed for, add up to $2,150. That is going to be the maximum that I can spend on my house payment and my monthly debt. So again, guys, your debt to income ratio, this 43%, very important because that is the maximum debt to income ratio that you can have if you want to get qualified in today's real estate market. So let's recap again and go over the 3 key ingredients to becoming a homeowner. You need income, you need credit, and you need down payment. If you have any questions about any of these topics, feel free to give us a call, visit our website, or go ahead and shoot us an email. Again, remember to subscribe to our channel, share this video. I hope you guys found the information valuable. I'll see you soon.